Hi, Michelle. Which risk in private credit do you think is most underappreciated today?
One risk in the direct lending market that I think is underappreciated is refinance or exit risk, but specifically as it relates to materially underperforming or workout credits. In today's market, there continues to be a supply-demand imbalance. Really, it's too much demand, driven by ample direct lending dry powder and overall muted transaction or M&A deal flow. As a result, quality or marginally quality credits generally are able to be refinanced. But as credit quality materially worsens, there are no markets to refinance or sell assets, or the terms or outcomes are not satisfactory to lenders.
So, how do we manage or get ahead of this?
Our strategy is to avoid or minimize the number of transactions that become true workouts. For us, it starts at underwriting, focusing on quality borrowers and transaction structuring, so low leverage and low loan to value. Because we invest in the lower middle market, all of our deals have at least one financial covenant, and the financial covenants are set at levels that trip and cause defaults as performance declines. Our credit facilities are illiquid, so we can't easily go to the market and sell our debt. As lenders, we can't in ordinary course force a refinance or a sale of the business. These defaults get us a seat at the table with the borrower and an ability to reevaluate the situation and influence if we want to stay in the credit or if we want to exit. As a result, through covenants and proactive portfolio management, we can avoid or minimize situations when we need to exit a credit in a workout situation.
Additional rate cuts are anticipated in Q1. So, how should an investor think about private credit returns in this environment, and why will spreads matter even more?
Let's talk specifically about direct lending. Direct lending portfolios are typically floating rate, so in today's environment, it's important that investors refocus on yield and therefore returns having two primary components. First, the base rate, which floats and is cyclical or driven by economic cycle, and second, spreads, which is structural or negotiated specifically with each transaction as compensation for credit risk. The last few years, there's been a focus on all-in yield as markets. It has experienced both higher base rates and generally wider spreads. In today's environment of rate cutting or declining base rates, investors need to recalibrate and focus again on spread. So why will spread matter even more? Spreads will become the dominant or largest component of yield, so it will drive and determine stability of returns for investors. If a lender is able to originate loans with wider spreads without taking on unwanted credit risk, even in a declining rate environment, acceptable return levels versus the broader market can be maintained for investors. So in Q1 and 2026, generally, as the market experiences a further shift away from base rate driven returns to spread driven returns, investors should also focus on manager selection, selecting managers that focus on borrower quality and loan structuring while maintaining entry level spread discipline despite competitive dynamics.
Thanks, Michelle. It was great hearing from you.